Welcome, everyone, to the webinar hosted by Catholic Investment Services. Thank you for joining us today for what's now our annual Macroeconomic Outlook program. My name is Tom Lanctot, and I'm privileged to serve as the Chief Executive Officer of Catholic Investment Services. My colleagues, Zayla Starjan and Sophia Kyra, have done a great job organizing this program, and Zayla is at the Zoom controls. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a nonprofit Catholic organization providing sophisticated investment solutions for Catholic institutions and their investment consultants, and now manage approximately $1 billion of client assets in 5 different strategies. An important part of our nonprofit mission is offering educational programs like this one for the Catholic investing community. Our next program is February 7th, entitled Mensurum Bonum 1 year later, that will feature a discussion moderated by CIS founder and board chair Scott Malpass. Scott will be joined by 3 other prominent Catholic thought leaders who, along with Scott, attended the Vatican's recent conference on Mensurum Bonum and faith-consistent investing. Enormous thanks to today's 2 accomplished panelists, whom you'll meet shortly. Today's format will be conversational. Our audience is muted. There will be time for audience questions during and after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question. You receive biographical information for our panelists, but I want to emphasize a few highlights. Jack Brennan is familiar to many of you as the star of various CIS programs and through his many noteworthy corporate and philanthropic leadership roles, including as a founder of CIS and the founding chair of our board. Jack will be our player coach today. Now, Joe, I had a wonderful introduction prepared for you, but Jack wanted to do it instead, so I'm gonna punt on that for right now. But we were talking about Jack. What did you say? Nobody knows nothing.
Correct.
Nobody knows nothing. I think if these guys don't know what's going on, I don't know who does. And Joe, you know, Jack's got to be here, but Joe, please know how grateful we are that you're with us today. So before I turn it over to Jack, please join me in a short prayer. Dear God, please grant us the serenity to accept the things we cannot change, the courage to change the things we can, and the wisdom to know the difference. As always, we pray for peace and civility and offer prayers and thanks for the women and men religious, their lay colleagues, and the many volunteers who, through their work for Catholic ministries, have devoted their lives to something bigger than themselves. Finally, as we reflect on the difficult journey that the Holy Family faced as refugees in Egypt, we pray for an end to the suffering of all migrant families. Amen. Jack, take it away.
Thank you, Tom. Zayla and Sophia, thank you guys for organizing this. And it's a huge pleasure to have as our guest one of the most respected economists in the asset management business, Joe Davis. Again, you saw his bio, but I want to flesh that out just a little bit. You know, Joe is the global chief economist and head of investment strategy at Vanguard. Joe joined the company as a one-man band in 2002, I believe. Joe, is that correct?
Yeah. Yes.
And we weren't sure we needed an economist in those days, but we got him on the cheap because his father wanted him to work at Vanguard, I believe is the case. So we rewarded his father by hiring his father later on, which is even better. So we had 2 Joe Davises just to make life interesting. But you know, in all seriousness, Joe is one of the leaders in his field. He's a proud graduate of St. Joseph's University in Philadelphia with a PhD from Duke, and he's one of the great contributors of his time and talent to organizations, both in his profession and in his community. On the professional side, you know, Joe's requested to be a frequent speaker. It's one of the reasons we're particularly pleased to have him. He serves on the editorial board of the Journal of Portfolio Management, Journal of Fixed Income, 2 of the most prestigious publications in our industry. He also was selected as one of the few non-academics, as in at a university, research fellow at the National Bureau of Economic Research, one of the prime areas that actually the people who declare or don't declare a recession because of his work on business cycles, having done just tremendous work in that regard. On the community side, Joe serves as the board chair at his alma mater, and where his son went, Malvern Preparatory School, one of the premier, Joe might say the premier Catholic secondary school in the Philadelphia area, and has done a fantastic job leading that wonderful institution to greater heights of accomplishment in that role. And I know they're very, very grateful. So he comes with great personal credentials. Professionally, Joe leads a 75-person research organization that's responsible for Vanguard's thought leadership agenda, as well as development and oversight of the firm's investment methodologies and models. Macro is what he does and his team does. And that's why we thought we reached out and asked if Joe would be willing to share some of his thoughts, both about where we are today in the markets and in the global economy. And then very importantly, later on in the discussion, we're going to talk about what's in many ways more important to our clients at Catholic Investment Services, which is longer term trends in the global economy, and thus by implication, global markets, because, you know, the endowed portfolios that we serve are really should be thinking in 5, 10, and 30-year increments, not what happened last year or the year before or what's going to happen this year in those portfolios. So Joe's done some, and his team have done some really interesting work that'll be thought-provoking and I hope provocative for you all who are with us on this call today. In that regard, you know, our objective really is to provide you with perspective from a unique seat in many ways. If you think about a $8+ trillion enterprise that is Vanguard in all the global markets, operating globally as well, fixed income, equities, alternatives. Joe's got a point of view on a perspective on the markets that is very rare, and he has a wonderful way of presenting his thoughts in that regard. So with that introduction, we're going to have a conversation about several issues before we turn to the long-term perspectives of megatrends that Joe will share with you and we'll discuss as well. So Joe, let me as you know, I love headlines. This time of year is fabulous. And with all due respect to your colleagues, share a couple to be provocative for a second and ask a question related. Two from the Wall Street Journal in subsequent weeks. Last week, the headline in The Economy, the outlook was, nation's top economists are short-term happy, long-term glum. And this week's was, it won't be a recession, it'll just feel like one. And each of the stories has a lot of on the one hand and on the other, which is a specialty of the economic profession, but not you, Joe, because you know this stuff. But big question. A year ago, we took the headlines are all about the recession that's coming. Will there be a soft landing, a hard landing, da 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 da. You didn't actually believe that, I know. Just tell us how the forecasts were wrong in a sense for what would happen, what your gut instincts are around why the last 18 months have turned out better than people thought, what the implications might be for the economy as we go forward.
Well, thanks, Jack. And again, I'm honored to be here, and thanks everyone for their time. And in fact, I thought one of the headlines was going to be economists got it wrong again, but then that really wouldn't be a headline. I mean, that would be more expectation.
Yeah, right.
It's tough. I mean, I think there's three things going on, and some of these forces, developments, Jack, are still relevant today. So, you know, one was, you know, I think a natural related question is how can you raise interest rates, meaning the Federal Reserve, from a 0% almost 2 years ago to over 5% and not have any slowdown, material slowdown in the economy. One of the reasons why I said we were going to have a slowdown, it would take some time, is because in a very simple way, rates were at 0 and now they've risen tremendously, but they are only recently above the rate of inflation, which is a very just simple way to say they're not really restrictive. You know, so you don't have to be an economist to say if my income's growing up faster than where I can park my money, it's not truly restrictive. So we've entered that territory now, but I think some of the recession expectations were just simple thinking in we forget that the Federal Reserve started from a level that they were the most stimulative since World War II. And so they were digging out of a very deep stimulative hole. And so that gave a level of shock resistance. I think we're fine. There's one other thing going on. One is that, and you hear it now, there's a lot of belief, almost near certainty by the markets that we'll have a soft landing, which is rates will fall, inflation will come magically down, and we'll have still full employment, which means the economy just keeps chugging along. I think there's a little risk to that belief, in part because some of the tightening has just been delayed. So there were offsets last year: consumer balance sheets and income. Fiscal thrust was still positive, meaning the government was still spending. You've seen that in the green energy sector in particular. Some of those are going to fade, and so I think we just shouldn't continue to expect this almost nirvana, which again, it's wonderful to have. It's historically unsustainable. So I think that's the territory for this year. It's not that a recession will necessarily automatically happen. It's just that this notion of a soft landing, I think, is naive in saying it's going to be a very high probability.
It's that 0 to 5 is an amazing move in some ways, right? You know, you go back 40 years, there were 100 basis point moves in short-term rates to break inflation back in the Volcker days. So let's just pick up on that for a second. You know, one of the interesting things in the markets was a lot of people moved to cash because they could actually get a return on their cash. And the temptation to think, well, I'm getting 5% in a T-note or in a money market fund or somewhere else is pretty real. And you mentioned real returns. What should be the real return on cash for people? And is this a little bit of a sugar? Has this been a sugar high as rates have come up this high in terms of utilization of cash and the appeal of cash as an asset class?
Well, yeah, Jack, and you hit it on the head. I mean, I think everyone would agree on the call. You have to think in real return, which means you're going to exceed the cost of living for a portfolio and a corpus, other than some small cash management vehicle. And so, over the long run, cash has only exceeded the rate of inflation at best 100 basis points, so 1 percentage point. Now, the Fed is a little bit higher than that because they're trying to slow down the economy. But the past 20 years has been the opposite, right? What some would call financial repression, which just means you're getting diluted sitting in cash. And there was a forcing mechanism to try to stimulate more risk taking. I think some of those days are over. In fact, the theme of our publication for 2 years, Jack, at Vanguard has been the return of sounder money, not necessarily Fed policy, but the fact that as interest rates are unlikely to return to the zero bound unless something dramatically happens. So again, I think you have to think in terms of non-cash investments because they truly are investments. If you're going to sit in cash, my only question to some is, what's the exit strategy? What are you doing 2 years from now, 3 years from now? Because that was the risk coming out of GFC. Some, I think, risk aversion, they went to cash. I'm not criticizing as a Monday morning quarterback. I'm just saying, what is the exit strategy? Like, when are you going to redeploy and have that so again, I don't think most people are timing, but if you're going to be allured by cash, when are you going to get out of that investment? Because it's not going to be an all clear. By the time the market gives you all clear, you've lost half of the return that you're banking on for the next 30 years.
Yeah, the lower for longer on the short end penalized a lot of retirees. You had a negative return on cash for a decade, more than a decade, probably, correct?
Definitely. Financial repression. I mean, I think the savers were sacrificial lambs of monetary policy. I'm not criticizing the Fed. It's just that they were trying to stimulate asset pricing and risk taking. That was more of an extreme situation. And our theme has been is that slowly some of those forces that were keeping interest rates down benefited current stock prices, boosting them up because low interest rates. But that was the worst thing for long-term investors. So the fact that we are closer to, like, we're at 5% roughly, I would argue is the single best financial market development in the past 20 years. In fact, I don't think there's a close second.
Really?
I don't think it's changing around. And that gets to even some of the narrative of fears of rising rates. I'm not saying it can't cause short-term disruptions. The worst fear I have had for 15 years was we were never going to get off the zero bound.
Right.
Because of the compounding effect that does to any portfolio. Because any portfolio, even all privates, are just a premium over and above the risk-free rate. So over time, that's going to be a drag even for the riskiest, most aggressive portfolios over the long run. So this is a positive development.
So let me just pull on that again. So in a sense, from a long-term standpoint, you feel like we're in better balance than we had been
Capital
leading.
allocation. There's a time value of money, which is a fancy economic way of saying, listen, do I want to have a prudent allocation? Before it was term out risk, take principal risk, because zero, I mean, you're at zero. And so it's all in price return, not income return for those the investment, those that are investment steep. So this is better balanced. I think it's going to lead to more prudent allocation decisions over time. I think they become a little tougher, but I think that's a good thing. So that I hope we don't return easy money. And that would be my counsel to policymakers is don't rush too quickly unless you're trying to stave off a recession. Then of course you cut, just to preserve jobs.
They have to stave off a recession, Joe. I mean, they're a natural part of the economy. And when you think it was the first time ever there was that you had a forecast, you might have a recession or a down 3/4 down or whatever. Aren't they healthy? Isn't a recession healthy in a long term from a long term perspective?
Well, yeah, I mean, in fact, a little anecdote for anyone wants, to that point, Jack. Over 50% of the companies, the S&P 500, were actually founded during recessions. So creative destruction, you do see that. Now that said, you want to try to any policymaker you want to take the edge off of it so that you
Right.
don't have compounding. I mean, that was even in play during COVID. Right? You talked to policymakers, I did. It was more of this is such a rapid fall. You don't want to have good companies go out there because of solvency issues.
Right.
Liquidity issues, not solvency issues. And so you're trying to disentangle the two, but it's not the worst thing unless you're obviously at the bearing the brunt of it. I think policy. That's why policy is tricky, because if you only care about minimizing near-term loss, there's a trade-off with potentially capping longer-term gains in the same way there is for investing. And that's my counsel for policymakers: is don't rush too quickly to try to stave off something that may happen, because there's the so-called Heisenberg principle. The very act of observing that changes the trajectory. And I think that's the risk of the soft landing narrative. If everyone believes it, we're going to have a different outcome at the end of this year.
It's been what it felt like 2 years ago with the prospect of rising rates, right? That it was the end of the world. And so you ran the risk that it was the end of the world. So let me just ask you from a practical standpoint. I'll give you my biased opinion, and then you give me a smart guy's opinion answer. I think the markets handle a sharp rise in rates better than I thought it might, because there was so little experience in the fixed income trading world and portfolio management world in a rising rate environment, because most of the people who lived through it in the 70s and early 80s are on the beach someplace, and that was the last time you had rising rates. What's your point of view? I mean, you live, trillions of dollars in your hands in the fixed income world. How do you think the markets and the participants in the markets handle this differentiated, both on the short side and the long side? On the short end and the long end of the curve?
I'm with you, Jack. It was better than expected. Better. I mean, I was bracing for a little bit more impact, even though I said earlier, just a few minutes ago, that they were taking off a lot of accommodation rather than being really onerous and restrictive. This was not Volcker and taking interest rates to 10, 20%
Right.
above the rate. So, but it was a quick move. I mean, there's no doubt about it. So I think, and the Fed deserves a little credit in terms of some of the forward guidance and some of the credibility there. But again, I think better than expected, but not shocking, because it was not once it gets to today. And I think there's two things going on. One is that they were digging out of a very accommodative hole, and even today, our research shows that they are not as restrictive as some think. And which means the equilibrium or the long-term interest rates closer to 4% neutral. So yeah, they're over neutral. They're restrictive. I'm not saying they're not restrictive, but if you're that restrictive, we should see slowdowns in very cyclically sensitive areas of the economy, like housing, autos. So if anyone who's looked in those sectors know, if anything that's holding it back is on the supply side, it is the demand is not slowed significantly. There's been little bumps here and there, but so I think it better than expected, because they weren't as restrictive as people thought.
Yeah, it's interesting. So I want to turn to a different kind of policy, and that's investment policy. One of the things you handle at Vanguard. And last year's headlines were the death of the 60/40 portfolio.
Yeah.
And it was sort of comical in so many ways. That I think the 60/40 portfolio was down 17% in 2022. It was up 17% last year. Give me your reaction a year ago and how you think about the traditional balanced portfolio for endowed portfolios, or for somebody's retirement savings for that matter, but for endowed portfolios. Not that 1 year recovery answers the question, but just how do you think about it from a policy standpoint and how you advise clients?
Yeah, and for all the listeners, full disclaimer, right? You're probably going to expect me to endorse the 60/40 because I work at Vanguard, who's known for the 60/40, right? But I'll tell you where the math was. I think those headlines were unfortunate. Now the losses were real. I have a balanced portfolio. My principal statement, my statement went down, but the very source of the loss is the national defense mechanism for the 60/40, and that unfortunately was missing. What I mean by that is, Jack, 60/40 it did recently, to your point, and will in the future lose value temporarily if interest rates rise quickly because inflation is higher than expected. And so when that happens, stock prices go down, interest rates go up, bond prices, go down as well. So that negative correlation, and some were extrapolating that to the future. The fundamental flaw of those stories, Jack, as you well know, is for that to continue. It's not that interest rates have to stay high. It's like, no, inflation has to continue to rise at a faster pace than expected. It's not that it's at high. So if interest rates stabilize at 8%, the future 60/40 portfolio's return is higher than it was when it was at 4%. It's pure math. But now the rate of adjustment generates losses. But that rise in interest rates is the very national defense mechanism that ensures future higher returns. If I just draw a straight line. So it's not that interest rates in a higher interest rate world, 60/40 is underperforming. It's just not true. It's not mathematically true, has never been true. But periods when you have a rapid rise in rates from a rapid rise in inflation, you can have temporary underperformance, and that's genuine. So if someone is looking for perfect correlation with CPI, they're going to have to sit in cash, and they're going to give up the 60/40 or any benchmark like that of 5% real returns if they want to correlate with CPI. And that's the trade-off that's still at place today in the financial markets.
It's an important one for our clients who are thinking about long-term returns. You say you had losses, not realized losses. That's the other part.
Yeah,
that's the other part of the market.
But I'm not gonna, that doesn't mean the portfolio's flawed. It means what horizon are we collectively on the call? We trying to maximize, because we have to take short-term volatility in the NAV or whatever it has you, if you're going to have that long-term real return. And even privates, they have NAV volatility. Whether or not it's reported or not is a different matter, because it's just how private assets are tried to be evaluated. But every asset has this dynamic that you're going to have short-term volatility if you're going to capture that long-term expected return to outperform inflation on the long run. So again, 60/40 wasn't dead. In fact, the rise of interest rates actually sets a very strong foundation for future returns.
That's one of the, it's the headline that never gets written in the popular press, and it doesn't help. It doesn't do anything for CNBC, who makes noise daily as opposed to thinking in terms of decades and other things. Very, very important takeaway. Last in-your-face topic for many of the people, our guests on the call today, is inflation, because there are two elements in that, Joe. One where they're board members or institutional leaders of organizations, and you feel the inflation pressures there. And then obviously inflation has implications in the investment portfolios. How do you think about it? We had spikes. What do you, if I said, what do the next 5 years look like from you, where they were 1.5 to 2, maybe if we were lucky over the last decade? What do you think it is for the next 5 years? How would you see inflation broadly? Education and other nonprofits is a little more challenging, but just what are your perspectives there, and what do the markets tell you?
Well, and again, a lot of things drives inflation, as everyone knows. If we look farther out, it's going to be these bigger forces at play. Technology can hold it back. government and monetary policy are big drivers. Sustained deficits can lead to higher inflation. You see this in emerging markets all the time. You just
Right.
see it less in the United States because of credibility and other factors. Demographics can sway it one way or the other because how many workers are available. I think where we come to as an expectation is these long-running forces will tend to push up inflation more than it will push it down in the past. And there's books that have been written on that. Now that said, I think that's half that argument is only half made. And that's usually left. And then you'll hear this megatrends, oh, it's a higher inflation world. I hear it from some other asset management companies. The last point though is, do we really think over a long period of time central banks are going to try to neutralize it? So our work says there's going to be more inflation pressures. That just means interest rates have to be modestly higher to neutralize them. What's been unusual is the past 20 years, central banks are having to push inflation up. Now it's going to be what some would say is more normal. I grew up during the 70s. I remember those times. Like that was pushing down. It's going to be a little bit more towards that. I'm not saying we're going to 70s world. So inflation, long-winded way, Jack, I'm saying I still have a central inflation expectation of 2 and 2.5%, but it's not because there's no inflation pressure. What I have is higher interest rates, higher real interest rates, cash of 4 or 5%, which is where our neutral rate for the Fed is, to ensure that we get inflation at 2 rather than, oh, we're magically going to get 2 because everyone thinks it's going to be 2. That's, I think, naive thinking. And so the forces can push inflation up. The question is, what do central banks do about it?
Very interesting. So two last big macro topics, and then we'll talk a little bit about megatrends because there's your megatrends are woven throughout this conversation already. Global, pandemic. Yeah. We went from a globalized world to a deglobalizing world, according to the headlines, right? It's a big deal as investors, right? Because there's a lot of pressure about investing in China today, and should we be, and blah 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 blah. So, just talk a little bit about your view in terms of, global portfolios. So one of the great diversifiers that's happened over the subsequent, particularly for smaller endowments or for retail investors. But do you think we're going to see deglobalization, a neutral state where we are, or will globalization continue as an important part of an investor's point of view that they ought to get diversified in equities or fixed income assets or and so on? How do you think about that? Again, headlines having been it's over because we got COVID from China. How do you play that out?
I think what you'd have, and if you think of globalization, there's been ebbs and flows. We have deglobalized temporarily in past human history. It was in the 1930s. I think that we'll probably see what we call snowballization. So you may have a plateauing or slowing in the pace. So the cost curve will bend a little bit, but it won't break and go down. Why I say that is I think we'll see, Jack, I think we're already seeing it. What our research shows is, okay, maybe more expensive than manufacturing something in China, but it's not going to be cheaper to necessarily manufacture in the United States. What happens is what you study, when you actually study the patterns, what you find is you see a lot of change in the source of the imports or of a company's profits. You see changes in the source, but it's not coming between domestic and all the rest of the world, if that makes sense. So if it's not China today, it'll be Vietnam tomorrow, maybe 10 years from now, it's Africa. So there are going to be changes in where the trades are coming from, but it's very unlikely we're going to see a full step back in the global supply chains. I think we're going to see a greater appreciation for risk management. If you want overnight delivery from one source, that's just risky. It's just that that risk wasn't realized until COVID. So I think that would be, to truly deglobalize would be stagflationary. I mean, meaning you'd have loss of a little bit of efficiency. You'd have a little gains here and there. Some industries would benefit from onshoring. There's no truth about that. And we can get into free trade and all that because the playing field's not always level. So I won't get into all that, which economists assume that's not true. But I think that we won't see massive changes in inflationary pressures. What you'll see is probably changes in the source of where the trade's coming from, a little bit maybe away from Asia and other parts. That gets to the global exposure. I mean, I think you want to have some non-US exposure, even if assets are near perfectly correlated. You don't need even low correlations to invest in two asset classes. It's just, I don't know which one will have a higher return, even if the correlation is 99%. It's return diversification, which is really the power where you want to have a little bit of exposure outside of the US. And I'd say that for any investor in any part of the world.
Very helpful. Last current topic. There's a little bit of geopolitical stuff going on, and so one of my favorite headlines that came in the inbox this week is geopolitics. Why bother? Question mark. And a long piece on it's just noise. How do you think about it? Whether it's as narrow as supply chain issues with the Red Sea, it's as big as two high-profile wars going on, elections around the world. Are geopolitics something that you and your team factor into your forecasts and your advice to clients?
Well, it's very tough. Is in fact the one person making a note. It's very tough directly. I mean, there's no geopolitical factor that summarizes all this stuff. But I think it gets to risk management and how you approach even evaluating a portfolio. In my world, evaluating a forecast, we never produce point forecasts. It's around a distribution. And geopolitics is just another, it's not the only reason why we do it, but it's certainly another reason why, which is what is a range of outcomes that's reasonable. And that's why we always have a variance in our forecast, not only because there has to be, I mean, if not, that's just arrogance or being naive, but you have to respect that. And then from an asset, if those that are managing portfolios on behalf of their clients, it's around risk mitigation. How bad would things have to get for this strategy to outperform or underperform? So whether it's macro forecasting or investment portfolio decisions, I view geopolitics as just underscoring the risk management nature of saying, is our strategy generally sound within this range of outcomes? Now let's do some stress testing, because geopolitics in many ways are forms of stress testing, right? It's unexpected, it's tough to handicap. They can have dynamics in them of their own. So that's how we generally approach it. That does not, so again, we don't have a geopolitical factor and we model it. It's more of, let's play this through, and then how does that look at the distribution of risk relative to what the market is assuming? Sometimes the market's naive, sometimes the market overshoots and is too pessimistic. That's the conversations we have internally.
Very interesting. It's I hope our guests are hearing how often you're in your work, just in your commentary, Joe, they're hearing risk, reward, and balance between those, and the various ways you could do that. It's interesting. And a related topic, and then we'll get to megatrends, is one of the trends that's gone on dramatically in some ways, from a low base to a high base, is the advent of alternative investments. To the most sophisticated institutions have had them for years and done really well with them. A firm like Vanguard now offers private equity portfolio up to option to certain of your clients. Just talk about how you think about that, how your own personal thinking has evolved, perhaps, about the role. Let's just stay in equities. How your own thinking is and has evolved about various ways one can get exposed to equities. Sure. I think it'll be helpful for our clients because it's a topical subject we hear a lot about.
Yeah, and you mentioned the models, and what I mean by that is the asset allocation we can optimize to investments. Think about a policy portfolio that anyone on the call may be on investment committee, right? How much should I give to each investment? That it's our work that we can do that for privates or publics, even a Vanguard, right? So you mentioned private equity. Our approach then yields, I think, some nuance but important insights I'd listeners to believe, and I think it's a different practice than what most consultants would start at. And that is, rather than start with, so you mentioned private equity. I see a lot of committees say, for whatever reason, we want to have 20% of a slug of our portfolio into this asset class, right? And they'll take the average returns, and they're not perfectly correlated, and then they'll say, okay, and then we'll fill the bucket. That is, in my humble opinion, that is an inappropriate approach to alternatives. That is not to say that one should not have them. What I mean by that is you or I cannot buy the private equity index, the beta exposure. I can only get snippets of it, which may outperform a lot. I'll just call it excess return. It could do extremely well and be top quartile. It could also be poor performance. My point being is if we did this for equities and say, Jack, I'm going to give you the S&P 500, that's what I modeled, but I'm only going to give you one stock. That is a lot of idiosyncratic risk. And so my only point is skill matters a lot. You could have more than 20% if you can identify very good managers and have a long horizon, or stay away from it regardless of what the 20% bucket says if you can't get skill to it because of the idiosyncratic nature, which means the excess return relative to the market. And so that's what our research comes, and that's how our framework does. So it's not Vanguard doesn't believe in alternatives. It's actually not true. You could actually have more than 20%. I'm using it as a hypothetical allocation, or less. It comes to just like active management, low cost, all else equal, and can you get the skill of that manager? Because you're going to have lumps of underperformance in regardless. Even the stars have them. So you got to have that long horizon. So I hope that comes to the audience. You can have more than that. I am not speaking against private equity. There's some great talent there. In a zero-sum world, though, can you identify it and don't just fill a bucket with a bunch of funds that are high cost? I think you just got a very high cost index portfolio. And sometimes I see that, not all the time, but sometimes I see that approach.
Great advice. Great advice. Let's pivot from the macro on January 17th, 2024 to the future, if you will, a little futurist work. And I've had the pleasure of seeing some of the work you've done here, and it's really, you and your team, it's really thoughtful. So let's share with us a little bit, because this is, again, you're overseeing an endowed portfolio. The next 5, 10, and 30 years matter a lot. And what things to pay attention to, how they might fit together, what the implications might be, are really interesting. So let's flip through your themes around this, which will get a little more public airing next week, I guess. Is that
next
right?
Week, the research, I'm happy to share. And when Jack and I were talking, I shared this, I've shared it internally, but it's the first time I'm actually sharing externally. But the research will be published next week. It'll be the foundation of a book we plan to write towards the end of the year. And Zayla, if you could show a slide just for the audience, very high level. I only will show like 2 exhibits, but I think it helps ground some of the issues that we were struggling with and continue to struggle with. These are big picture issues. Jack, you mentioned megatrends. What I mean by megatrends are some of the hexagons on the left-hand side of the screen. These are slow-moving, big picture things that ultimately drive stock returns, bond returns. They affect inflation and growth. It was some of your questions, Jack. It's debt levels. It's the aging of society. We have the energy transition, right? How much is that good? How long it will take? How much will stimulate growth? We have demographics and a slowing population. And of course, technology and globalization. So the key question is, what are the impacts of the next 5 years? Because I would like to think, in fact, I surely bet, regardless of whatever the Federal Reserve does this year, and that'll have an importance for 2024, it'll have almost no bearing on investment success in the year 2030. So how does one think about these forces? Sometimes these forces reinforce each other. Sometimes they go against each other. And I think that and so what I showed on the right is, a lot of, very thoughtful people, luminaries or experts in the field, they're taking a stand on how some of these mega trends may play out in the future. So I'm not picking on these books. I don't have a book written. Unlike you, Jack, I'm not an author. So these have authored, and these are some really speculative field, but I put underneath what some of the views are. Some think we're going to have a fiscal crisis because we're going to continue to expend money, and we're going to, demonetize. We're going to have a debasement of the currency. That sounds very alarming. If I'm an investment community member, how do I think of my portfolio in that world? You have others thinking about stagflation, supply chains are only going to get worse. U.S., China, that's the mega threats example. It's stagflationary. Inflation goes up, growth goes down. You can imagine that's not terribly supportive for asset prices. And then you have others thinking it's an aging world, high inflation is inevitable. So as an economist, I'll be very candid to everyone in the room. I get asked a lot about the Fed and so forth, and I have answers. I'm not saying I have the right answers. I have answers. These are tough questions. We didn't necessarily have a numerical answer in a risk sense, like how likely are these scenarios going to occur, and not just guesses from Joe Davis on a Friday afternoon. Like thoughtful answers we didn't have, and in fact, the industry does not have it. So what we've done over the past year has been to try to model these as best we can. We can generate future returns for, in the US case, how will all these forces interact with each other and what will it mean for growth and everything else. And what's been a positive surprise for us is that this gives us two insights. One is the status quo forecast that almost every agency has, the Congressional Budget Office, the Federal Reserve, for the long-term assumptions of roughly 2% growth and 2% inflation, that's so-called consensus, the odds of that happening are low. And it's because of the nature, and factually, what our research is showing of all those six hexagons, all that truly will move the dial in the coming 10 years is a horse race between two, and that is technology and how fundamental and transformative artificial intelligence or AI is versus the structural deficits, which are tied to age-related spending in the United States. That's the horse race of the future. These other factors have some importance, but they really don't move the dial. And that in of itself is an innovative insight. Like, how do I think about all these? Those are the two forces. And so in terms of that comes down to that. So how will technology play out? And this has bearing even for Federal Reserve policy today, believe it or not. Zayla, if you could show the next chart real quickly, what this research does, it gives us very innovative insights. Now, there's a lot of going on. You can move it to the next slide, Zayla, sorry. And I just want to show like the sort of insights it does. The graph, and it's centered at 0. This has been the rate of innovation, but you can think of it as trend GDP growth if you're an economist. Think of this as the rate of innovation in the United States over the past 130 years. So we've used new data, state-of-the-art techniques. I won't bore you with the details, but it's a sound methodology. And what this does, and this is the first time, my knowledge, that this has been done in academia or industry, we're able to decompose the sources of why trend growth and the rate of innovation is so low. And what that shows is it's not the lack of skilled labor, which some people will point to. Yes, it would be nice if we had more skill, education workers in society. Of course, that would be positive. But what is holding back growth, and Jack, to your question before, what was in part contributing to the low rate environment in the past was a low rate of trend growth. And it shows you right here the big reason why growth has been low. And the Federal Reserve, by the way, expects this to continue for the next 5 or 10 years. Is that we have too little emergent technology. That's that maroon circle. That's why it's pushing the line below 0. And we actually don't have enough automation. So I hear a lot of concerns. I have 2 children who are college age. What should they be studying in college? Is AI going to destroy jobs? Are we going to have too few workers and not enough jobs in the future? What this shows is in the US economy, which is 80% service sector, we have too little automation, which helped lead to the COVID price increase. Not all, but part of it. It's why we have very tight labor markets, yet we have low growth. And we have too little.
Hey, Joe, let me just interject for a second. Yeah. Did that surprise you? I mean, because it feels like we have a lot of both at some level. It feels like
we have a lot of innovation, but it doesn't show up in the data. Everyone has a GDP growth of 2. Used to be, when I went into the business, trend growth 3.5, and everyone thinks it's demographics holding back. It's the rate of innovation. So that has been the big struggle, Jack, as economists struggle on a lot of fronts. One of the areas of struggle is, why is that line below 0? Because we have disruption, we have tech companies at multiple year valuations, but the fact is that growth has generally been low. What I will tell you is not only do we tell the source of the growth, we project in the future. And what this chart, what I will just verbally tell you, is you can see in the past, we've had accelerations in growth, that maroon, because we have, emergent technologies. I circle computers in the internet. You see how it stimulated growth during the late 90s. Then you have electricity during the 1920s. And that's a long time ago. It's over a century ago. And then, of course, you saw it during World War II. So they stand out. So you see the variations over time. And what no one is talking about, that as the paper will be released next week, is shown with a greater than 50% probability, is that maroon will turn positive because AI is transformative enough and it will help to automate. Because if we don't have that, you're going to have what some countries have had, such as Japan. You have too few workers and you don't have disruptive technology. Japan's demise has not been poor demographics. It has been the lack of automation. And so what this tells us is that for many developed markets, actually the risk is towards the upside for growth, not on the downside. Not one of those books I showed before talks about upside risk to growth, respectfully. And so this means two things. One, it means that there is a hope that we can have somewhat higher growth, and we're going to need some of that because the fiscal thrust of the entitlement spending are pretty significant in the future, and will start to generate some modest inflationary pressures unless we see technology such as this switch. And so this is what likely will happen. This will start to switch, Jack. AI will probably become more transformative than computers and the internet. It probably won't happen though for another few years. It certainly won't happen overnight because it takes time for companies to adopt it, to incorporate it. For electricity, it took 30 years between Edison and when the economy actually boomed. It took 30 years. This will be a shorter window than that. But nevertheless, I think this is good news, and it's a dynamic that if you're an economist, no one is talking about. This does not mean that markets aren't overvalued, because they are in the US equity side. But it does mean that another reason why we think it's an era of return to sound money, because you're going to have modestly higher interest rates because you're going to have a higher return of capital in the future. And so this is information and forecast, Jack, that we're going to start sharing publicly. This has bearing in the near term, and it has more bearing longer term for investment portfolios.
Fascinating. I can't wait to read the paper. And with your permission, we'll post it on our website and let people have a look at it as well once it's out in public. Really interesting stuff, Joe. Really interesting. I want to turn. We have some great questions from the audience. So
let's take them.
Now you're in trouble. Smart people are asking you questions instead of me. One that's sort of natural, and I should have asked you myself. When I was a kid, the bonds and there was negative correlation between stocks and bonds, and depending on your sense of valuation, you moved from 60-40 to 62-38 and so on and so forth. And it's interesting to think about whether you think there'll be positive or negative correlations between stocks and bonds from where we are today, looking forward 5 years or 10 years, take a pick.
Yeah, and again, we model it not because we'll get the point forecasted to the person's question, Jack, right? But we're looking at the range. Just for historical record, the average has been 0.2, so low, which is why you put those asset classes together. They're not moving perfectly. We come closer to that, slightly higher. Why is that? You generally get negative correlations in a deflationary environment, which means interest rates are falling on average. But the 60-40 or a relatively balanced portfolio, you only really run into headwinds if the correlation starts to approach 0.7 when we've done all the correlation, which is really high. That's actually the correlation between US and non-US equities, not the correlation between stocks and bonds. Now, that correlation during those 2 years ago, the balanced portfolio was under its demise. That correlation went positive for 12 months, like pretty high, right? But over long periods of time, it's unlikely. The only way you get really positive correlation on a sustained basis, I can't underscore this enough, inflation has to rise and continue to rise higher than expected. It's not just that inflation's high. Eventually, the bond market starts pricing in higher and higher inflation. As soon as it does that, then the correlations flip back down. So we're assuming a modest positive. You don't need negative for you don't need a negative correlation for the 60-40.
Right. So it's a related question, which is provocative and one that's natural in some ways. It's this: from an endowment point of view, with a forever time horizon, why not be in stocks almost entirely and avoid bonds in the portfolio?
You could. I mean,
I'll see if you have the right. I have the right answer. We'll see if you have. I'll see how you do.
Again, for some portfolios, if I had an infinite horizon, I'd be starting at 100% equity and then saying how much volatility can I withstand. You could optimization will give you a small slug to bonds because there's a little diversification, even if I have a 100-year horizon. But I think that's semantics, Jack. If I'm looking out a million years, I put in the equity risk premium, which is stocks, and let it ride. My only hope, it's not stocks that get in trouble, it's the human beings that get in trouble. It's the Joe Davises of the world panicking in 2009 saying, we got to do something. That's the only risk to the strategy. It's the human behavior element. So that's my answer.
I think there's another risk, which is drawdown risk. And if you, once you tap, you lose 50%, and you have to tap that. That's the risk. If you need to draw.
Jack, in fact, thank you for bringing that up. In fact, that was my miss in my response. I am assuming no one is drawing down that portfolio. It'll push you 100%. If we're drawing down from a portfolio, different calculus. Now I got drawdown risk. Now I got a smooth volatility, and you don't want to draw down exactly the moment when you want to capture. You actually want to be deploying capital into a selling market, and so it'll back off risk, not because you can time the markets, but because you're saving that dry powder in your mind, so that when 2009 hits, you're not drawing it all down and then spending. So you would want to have back off the 100% equity because you're spending a portion of the portfolio, and that's what an optimization in our models will do. But if I'm not drawing down at all, I don't have to spend from it. Forget 4%. Then
definition. So you know what Murphy's Law is, right?
Yeah.
Do you know what O'Toole's corollary is?
I should know, but
you should. You've probably heard it from me before. O'Toole's corollary is Murphy was an optimist.
Yeah.
And my view is that if you go 100% equities, invariably you're going to have to draw it down, and you never get that money back, right? Because it's sort of the way the world works at some level. But anyways, that's
and again, how many people have that risk tolerance? How many institutions have that risk tolerance in seed capital? I mean, it's a high bar.
It's a high bar. But if you're an individual and you're not drawing against your portfolio, it's a different story. You're adding to the portfolio. Why not in that regard? Couple of other last quick questions. Let me question on inflation. Given the rise in prices, particularly food, housing, automobiles, durable goods, these increases seem to be holding despite decreasing inflation and wages. What's the long-term implication of this situation as prices seem to outpace wage increases? You alluded to it before, but are you a fan of CPI as an actual measure of inflation, or are there other ways you think about it and the long-term implications?
Yeah, I mean, it's got major limitations. My parents don't have that CPI rate.
Right.
They have higher healthcare. I don't have that CPI rate. So it's an average of an average. Inflation's sticky. It's been our theme, which is why our view has been for some time the rates were going to have to go higher by the Fed as a year ago, Jack, and they would have to hover them there. And it's my counsel to policymakers today: don't rush to cut rates. We don't have inflation down to where we need it to be yet. And by the way, the labor market's still tight. If you've talked to any business, it's loosened a little bit, but it's still tight. So I'm worried about what some call the risk of 67. I mean, that's what I've called it. It's the only time, one of the few times in U.S. history we had a soft landing. And everyone cheered. The yield curve inverted, we avoided recession. The stock market went ripping. The Fed cut rates from 5.5 to 3.5, with the unemployment at 3.7%, which is, by the way, precisely where it is today. The labor market had slowed, but it was still tight. Vacancies exceeded unemployment rate. They cut rates. I would call them dovish. There was little tremors in the bond market, by the way. Sounds familiar. Now, it's easy for me to be Monday morning quarterback. What I'm saying is I think they took their eye a little bit off the ball. Within a year, they were raising rates again because the labor market resurged, which is good for workers, but it brought back inflation. By the way, CPI at the time was 2.5. They had to take rates from in the mid 3s to 9% by 1969.
I didn't realize that in the late 60s. Interesting.
Yeah. Now, again, we have better inflation expectations. The world's different. Oh, yeah, we had the Vietnam War. Yeah, well, we have different fiscal spending. So I'm not trying to make it exactly. My point being is the policy, let's not be in a rush to cut rates. Let's be prudent here. I'm not saying modest cuts, but I hear the questions. Like, inflation's still sticky. Let's make sure it doesn't come back. And be careful how quickly you raise the cut rates.
And I know they actually asked your advice, which is a good thing, that the policymakers want to hear from Joe Davis in various forums. So I hope they take your advice, Joe. I'm gonna stop this with a marker. So you have to say yes. Will you come back again sometime?
Oh, anytime.
Okay, this is being recorded. So at least from this chair, and I hope from our guest
Economists
chairs,
never get asked back to the same forum. You have to understand that.
I can guarantee you we'll ask you back because we 2 more hours of stuff we're going to talk about. But I hope as kicking off the year of these sessions for us and keeping it macro, couldn't have been better, Joe. Thank you so much. Tom or Zale, I'll turn it back to you. And with 3 minutes to spare, we like to begin on time and end early.
We like to end early. So, Joe, Jack, great conversation. Can't thank you enough, both of you, for the level of preparation and obviously the great insights that you offered. Thanks to our audience for joining us today. Please take a minute and fill out the audience survey that will follow. And we're grateful for your interest and support and wish you the best for the coming year. So we are adjourned. Thank you all.
Thank you. Bye-bye.